Hey, what's going on, everyone? Today we're going to analyze a recent duplex acquisition in upstate New York. Together, we'll walk the property, review the current market, discuss different financing options before finally wrapping up with what the ultimate exit strategy on the project is going to be. My name is Stephen Lutman with SJ Lincoln Realty. Let's get into it. Here we are in Glens Falls, New York, 30 minutes north of Saratoga Springs, 15 minutes south of Lake George. What we're looking at here is a 3,000 square foot duplex comprised of 7 bedrooms, 3 bathrooms. Each unit could be described as habitable, however, would benefit significantly from renovations. Walkable to downtown, half-mile from the hospital, off-street parking, in-unit laundry. There's a lot to like here. We just need to get the units into a condition more appropriate for today's renter. As real estate investors, our focus is always going to be on location over a specific property. And the reason for that is it's easy to turn a bad property into something great. However, it's going to be a significantly harder lift for you to turn a bad area into something great. So we're focusing on location over property. The thesis for today's project is that it's a great time to own property in Glens Falls, New York. And let's go over a few reasons why here. We'll start with macro data, and this comes directly from the census report, which means it is going to be slightly dated. However, it does give us the trend lines that we're looking for. First number we're going to take a look at here is the poverty rate, and we do see a slight decrease year over year in the poverty rate. If you are going to be investing in real estate and in spending tens of thousands, hundreds of thousands of dollars, doing so in an economically depressed or an area that is becoming economically depressed is going to be a substantial uphill battle for you. So we're looking for growth. This gives us assurances that the area is improving in terms of the overall renter base that we're going to be appealing to. Next number we're looking at here is the median household income. Depending on where you live, $64,000 may seem like a lot. It may seem like nothing at all. The part we care about is the year-over-year growth, and that's over 6%. That is very attractive. Last number we're going to focus here on is, this is a real estate focused project, median property value. And we see 180,000. That's great. The number we care about, what's the growth rate? Over 11%. Now, is double-digit appreciation in home values sustainable? No, of course not. However, it does give us the trajectory that we see poverty rates are going down, median household income is increasing, and property values are increasing. These are all exciting metrics for real estate investors. Next we'll take a look at is, why do we want to invest in Glens Falls? It's getting better. In New York State, the government hands out yearly downtown revitalization grants. And in 2017, Glens Falls was the recipient of one of those grants. Just like any government program, it does take a while to kind of filter through the system. We're just now in 2024 starting to see the ramifications of the money that was awarded way back in 2017. So this is a new project that's going to be going on directly downtown. This is probably slightly less than a mile from the subject property. Lots of exciting things. So brand new farmers market, upscale apartments, new commercial space. This is very appealing because this says not only is the government money coming in, right? But what's even more attractive is private investors, private capital is saying, we want to be a part of this. We're going to be constructing new apartments, new projects. So we have government investing. We have big players in the private sector investing. We want to piggyback off of that, right? They're doing all the legwork. They're doing all the heavy lifting. We want to come in and tag along for all that hard work. What else is going on? Well, if you're into skiing, West Mountain Ski Resort is less than a 10-minute drive. So we have increasing property values. We have government grant money coming in. We have ski resorts for folks for recreation. The biggest employer in the area is going to be the hospital, Glens Falls Hospital. And we see that the current employment base, based off of data from LinkedIn, is going to be 2,300 employees. That's going to be far and away the largest employer. What's nice about that is healthcare jobs are not going away. And if anything, they're going to be increasing. So if you invest in an area where the largest employer is never fail safe unless it's government jobs. Government typically doesn't shed employees, but from the hospital perspective, these are very much in demand jobs. They're going to be high paying jobs, and these are the renters that we're going to be wanting to go after. So that's going to be kind of the case for why we're investing in Glens Falls. Improving area, downtown's getting better, recreational activities for people that might be coming in for short stays, and we have a very stable employment base. The next segment of the video is going to be how much should we pay for the property? So what we're going to be taking a look at here is the MLS recent sales. These are all the multifamily sales that have happened in Glens Falls over the past year. We're not looking at anything previous to a year. The reason we don't care about prior to a year is when the appraiser goes to appraise the value of the property, their cutoff is 12 months. So anything that happened 13 months plus, if it doesn't impact the appraisal, we don't care about it. So we're filtering results for, again, multifamily within the past 12 months. And we can see a gamut running anywhere from $80,000 for a duplex to, on the upper end, we're getting into the 300s, $498 for a duplex in Glens Falls. So really what that means is there's a little bit for everybody here at all income levels. How much should we pay for our property? Well, we discussed in the open that the condition is quite poor at this point. So we did sort this by the price per square foot. So again, we don't necessarily care about the purchase price. We care for the purchase price, what is it on a price per square foot? Because different properties are different size. We want to know on a price per square foot, what is it? And the cheaper options here, this first option we're going to ignore on Ackley Street just because that was actually a short sale. I'm familiar with that property. I've toured that property. That was not necessarily an arm's length transaction. It was a seller that needed to sell. So it doesn't really represent perfect market dynamics. Next, we'll take a look at here is this place on Maple, which is actually a next door neighbor for our subject property. And we'll take a look at a few photos here to get a feel for the condition. I did not have a chance to tour this property. It actually sold before I could get in. However, I think what we'll see is, it's kind of average as the day is long, right? This is going to be a perfect comp. Now, this is actually a 3-unit property, but that's okay. We can certainly still compare that to our property. So that's great. That's going to be very helpful for our purposes. The end up purchasing it for $55 a square foot. We'll jump down to this property on Walnut, which is going to be kind of a similar location to where we are. Let's get some photos up by this bad boy. No photos. That's okay. And how about this one on Birch? Because I believe I toured this one as well. Take a look. So very similar. This one does have a garage, so that's going to separate it quite a bit. The property we're purchasing also has a garage. However, it's in such poor condition, it really doesn't add any value to the property. In some respects, it's so bad that it's actually a negative because it's going to be a tear down at some point. So for this particular property here on Birch, they ended up getting 81 a square foot. So we're seeing some pretty drastic changes from 51 to 81. These are all still on the lower price point for the city. So I think ultimately where we want to end up is somewhere in the 50 to 60 a square foot based on comps, right? Because we don't necessarily care what properties are listed for. We don't care what if they've had an offer accepted, what potentially they could sell for. We are focused on what properties are actually selling for. And for the purpose of purchasing the property, our comfort level is going to be somewhere in the 50 to 60 a square foot. On the exit, what is that going to look like? If we were to spend some money, which we are going to do on cleaning up these units, what can we reasonably expect on the back end? And we'll take a look at some of the higher price point sales here. And these are clean, right? These are fairly updated units. They're attractive units. They're very functional units. They're certainly not wowing you, though. They're not knocking your socks off. So I think kind of our takeaway here is if we can get these cleaned up to a respectable level, get the rents up to where they should be. Here we see a 3-bedroom, 1-bath for $1,300, 2-bed, 1-bath for $1,000. If we can, our units are going to be larger than these. So if we can get the rents up to something that's going to more be representative of the market and what people are actually willing to rent for, it's going to sound aggressive, but I think a target exit is probably going to be 275,000 once we get them cleaned up. Just based on the square footage, the location. The location is definitely going to be a negative for us. This is not the most attractive part of Glens Falls, but again, we're so close to downtown that once that the growth starts to push out just a little bit, like we're right there. We're right on the cusp of being something nice. So, if we were to invest and do the updates well, making sure we're getting the most out of our money, when we go to exit, when we go to sell this property, is 275 doable? I truly think that it is. The last section of today's video will be the financial analysis. This is really going to be the meat and potatoes of today's video. This is what we're looking at here, a spreadsheet that I've built upon the past few years. It was actually a creation of a client of mine that I've kind of altered throughout the years. I will do my best to make sure that this is downloadable within the additional comment sections, kind of above the comment section for the YouTube videos. If for any reason I can't and you're interested in this, shoot me an email, steven@sjlincoln.com, and I'll be sure to send this over to you. But for purposes of today's financial analysis, we're going to be expecting a 5-year hold period for this project. And first and foremost, the purchase price, we ended up doing it for $150,000. We are doing $60,000 worth of improvements is the expectation at this point. That is not going to be a day one number. There are tenants in place. We're going to need to phase them out. So the expectation at this point is, though, to get the 2 units to where we expect to maximize revenues, get the most bang for our buck, $60,000 right now is the number in my head to make that happen. Closing costs, we'll think $8,500. And for the down payment, we're going to be bringing 20% to the table. Square footage on the property is large for a duplex. It's going to be 3,000 square feet. And the current rents for the front apartment is $1,200. The rear apartment is currently paying $1,300 per month. There is no additional income. There's no, washer dryers with, coin operated or vending machines or anything like that. Number of units, obviously this is going to be a duplex. We're going to be borrowing at a 7.5% interest rate over a 30-year hold period. The anticipated increase year over year. Now, this is going to be very different depending on where you live. For my properties and my expectations, I always bank on 2 to 3 percentage points of appreciation per year. That also means expenses related to the property are also going to go up by that same percentage. Now, you might live in a more high price area where that's, your appreciation is going to be closer to, 5 or 6. Obviously, you've been paying attention the past few years. A lot of areas have seen, double-digit appreciation in prices. I don't think anyone is making the case that that's going to be sustainable over the long term. Again, my head is 2 to 3% for appreciation, for increase in expenses. So that's what we're going to rock and roll with. For vacancy rate, you are going to have vacancies no matter how great your apartments are. So we are going to factor in a 7% vacancy rate for that. Repairs and maintenance, this is going to be very property dependent. Keep in mind, this is going to be outside of the initial $60,000 that we've already allocated. This is more of just what's it going to cost monthly to keep the building running. I like to say $50 per month per unit. So that's going to get us $100 for maintenance. Property management, you get what you pay for property management. If you shop it hard, you can get anywhere from, call it 6% to 10%. Now, I am going to be managing the property myself. However, that doesn't mean that we don't get to include property management in our analysis, because if tomorrow I get hit by a bus and I'm no longer able to manage the building, we want to make sure when we purchase it that in the event we do have to hire management, that we're not going to be significantly underwater by doing so. Property management is not cheap, so we are going to factor that in. Again, in the event that I can't or no longer wish to run the building, we want to make sure that we can actually pay to do so. Property taxes on the building are going to be $5,700. The yearly insurance came back at $1,650. Water and sewer is going to be paid by the owner. We can estimate that at $50 for a 2-unit property. Utilities, gas and electric are separate. So while the owner is going to be paying for water and sewer, utilities are going to be $0. Trash, again, is going to be property specific. I do own rental properties where I myself, as the owner, pay for the trash service, whether that's directly in your taxes in some of the municipalities, or you might have to hire it on the side if you have just like a large bin that everyone dumps into. This case is a little bit different. The tenants actually each have their own accounts with private trash collection. so it is not a burden on myself. Snow and lawn, the gentleman who's paying $1,200 right now has it in his lease that he's supposed to assist with grounds maintenance. Speaking with the other tenant, it doesn't sound like in years past he's done a great job with that. So I am going to factor in $75 per month for that, especially with snow season coming up. That's going to be pretty expensive. So that gives us a framework to rock and roll with. Now, we did say we're going to be improving the quality of the apartments, which means we are going to be commanding higher rents down the road. So year one is going to be a pretty safe estimate. By the time we get to year two, my expectation is one of the apartments will be more updated and we'll be able to command a higher amount being, call it an extra $200 a month. So that is going to be, call it $2,500 additional for the year. So we can bump that number to $33,000 in total gross income. And I think, by the time we get to year three, my expectation is the other apartment will be updated too. So if the $2,500 for year two, we can do the same thing for year three. So that's going to get us to, call it $37,000 in collections. And that's really going to be the end of the big increases. And after that, it's probably going to go back to the 2 to 3% growth. So that is kind of my expectations going forward. So what are the takeaways here? From a monthly cash flow perspective, right out of the gate, before we can get those rents bumped up, it's kind of slim, right? $300 when you're deploying tens of thousands of dollars is not a fantastic return right out of the gate. So the emphasis is really going to be on get into those apartments, get those rents up as quickly as possible, because you're taking on a lot of risk and a lot of liability, a lot of money going out the door just for a $300 return on a monthly basis. And then obviously it gets much more attractive once you're able to do that. From an exit perspective, when we talked about what the recent market was looking for in terms of higher end, and maybe not so even higher end, but more middle of the road, more updated units. My expectation was $275,000 is going to be an appropriate exit, especially 5 years from now with properties increasing in value. I'm going to stick with that. I do think reviewing the market 5 years from now, once we get the units a bit more cleaned up, $275,000 on the exit is going to be very doable. So now we're going to run through what is going to look like after year 5 if we were to sell the building. So we are going to have selling costs associated with it. That's going to be your attorney's fees, your real estate agent fees, just to be able to get the property sold. We're looking at walking away with $254. Obviously, there's going to be existing debt still on the building at that point, which is going to be $113, which leaves us with walking out the door with $140, and which is going to be very nice. And then on top of that, we do have the monthly cash flow. So we have the appreciation, which is going to be captured in the equity. And then we have total cash flow. That's the money on top of expenses on a month-by-month basis that's been coming in. So the projected return gets us to an annualized return of 13% over the 5 years. And again, a lot of that is going to be getting the apartments increased in value, because if we were to try to sell this building in its same exact state 5 years from now, the return would be pretty minimal, and we'd be fighting for lower quality tenants that are comfortable with not so great apartments. So as long as we execute on getting the units updated, as long as the area continues to grow at a pace that we expect that it should, we should have a pretty healthy exit after the 5-year hold. One thing we do want to further discuss is going to be the financing for the property, how we're going to purchase it. And we did this using a debt service coverage ratio loan. Now, this is going to be a little bit different than if you were to walk into your traditional lender, your traditional bank. They're going to be looking for pay stubs. They want to review your tax returns. They're going to be doing a deep dive on not only the building, but yourself. This is going to be a little bit different. When you're a real estate investor, you start to seek out different lending options that fit, kind of your goals and where you are in your investment portfolio. We elected to go with a debt service coverage ratio lender, which is going to be focused almost solely, specifically on the building. They did review my credit score, so they didn't ask for my tax returns, pay stubs, anything like that. They wanted to know, are you financially responsible? So we're looking at your credit report and your credit score. but more so, how is the building performing? They are lending almost exclusively on the building itself. So let's take a look on what that looked like from their perspective, them being the lender. And the ratio we're looking at here, debt service coverage ratio, is going to be your net operating income divided by your total debt service. Okay, a lot of fancy real estate terms here. Basically, they want to look at money coming in, money going out. What's the ratio between those two numbers? So first we need to calculate our net operating income. These have all been filled directly from our worksheet that we did here. So all of the work has been done for us. We know our rents are going to total $2,500 for the month. Repairs and maintenance, we said was going to be $100. Property management, we're calculating at $200. Taxes, your property taxes break out to $47.5 per month. Insurance at $137. And miscellaneous, and that's going to be your water and sewer, if we were paying utilities, things like that, everything else that comes with running the property. And that came out to $1,462, which again is going to be revenue. So we took the $2,500, we backed out all of our expenses, and that got us to $1,462. Two items of note that are not included in this calculation. First is going to be your interest payment. So we are taking on debt, but for purposes of the NOI calculation, interest, your mortgage payments, is not factored in to this equation. What else is not factored in is your capital expenditures. These are your big ticket items. You're putting a brand new roof on the property. You're putting in new heating systems. Large expenses are not factored in to your capital expenditures. So our debt service, and that's going to be, what's debt service? It's your mortgage payment. So the mortgage payment we came up with was $839, and that's again depending on a 20% down payment, assuming 30-year term at a 7.5% interest rate. And our debt service coverage ratio is going to be our NOI divided by our debt service. And that gets us a 174, which should not be a currency, it's just a number, 1.74. What lenders are going to be looking for? Okay, they want to see above 1.2. 1.2 is kind of the line of demarcation. If you're below 1.2, you're going to start being dinged by your lender. They're going to start charging you probably a higher interest rate or maybe some additional origination fees. 1.2 is, it seems to be the kind of the line that their comfort level is met. Some you'll see 1.25, but that really is it. Now, I was able to shop this myself. I do operate a lending business here. We broker real estate investment property loans. If you want more information on that, head over to knollhaven.com, KNOLLHAVEN, knollhaven.com. And there you can find more information about debt service coverage ratio loans, bridge loans, any type of creative financing you're looking to do for your real estate projects. That is something you can connect. If you feel more comfortable communicating via email, info@knollhaven.com is the email address. And that's not something that's going to sit around for a couple weeks. I mean, we do get back to you within 24 hours. So yeah, that's a little bit more information on debt service coverage ratio. We came in on this project at 1.74. That is going to be viewed positively. If you're going this route for financing, you want to make sure your credit score is as pristine as possible because you're going to fall into different buckets. So think of one bucket as what's your debt service coverage ratio? Is it 1.2? Is it 1.5? Is it 1.0? Negative debt service coverage ratio is going to be very difficult to find a lender for. It does exist. However, there's going to be a lot of caveats to make that happen. Really, you want to be targeting projects with above 1, ideally above 1.25. So the better the debt service coverage ratio, the better terms you're going to get, but also the better your credit score, the better financing terms you're going to get. The other thing they're going to be looking for is your experience as a real estate investor. Are you a flipper? Have you done many flips before? Are you a buy and hold investor? How many properties do you currently hold? If you can show some kind of a track record, that makes the lender more comfortable, the better terms you're going to get. If you are a brand new investor, that does not mean you can't do a debt service coverage ratio loan. There are private lenders that do these DSCR loans that will open up to first-time investors. However, again, you're paying a premium. So there's a lot of opportunities out there. Again, if you want to learn more about kind of outside of just your traditional bank financing, knollhaven.com, knollhaven.com, or info@knollhaven.com. And that's a conversation we can have. Shoot me some information about the project you're looking to get financed, and we'll see if there's something we can make happen for you. But that's kind of a breakdown in terms of debt service coverage ratio. Obviously, this is a pretty exciting project. I've been wanting to get exposure to Glens Falls for the past few years, so be able to do it with myself and my business partner, it's pretty exciting. It is going to be a bit of a lift. It's going to be a big project. Maintenance calls are already rolling in. We've only owned it for a few weeks at this point, but I'm pretty excited. It's going to be a good project. I'm hoping to be able to deliver a fun part 2 to this video down the road, whether that's going to be after apartment number 1 gets renovated. Maybe we'll hold off until apartment 2, but fingers crossed, hopefully this works out well and we'll be able to kind of improve the quality of housing in a city that I'm pretty excited to own real estate. So that's going to wrap everything up for today. Thanks for giving it a look. If you did find it enjoyable, shoot me a comment down below. I love hearing from you guys. We do plan on putting out additional content, more videos like this. So if there wasn't a topic that was covered, or if there was something that was covered, but maybe it wasn't given as much time and effort as maybe you'd like it to, let me know in the comment section. And that way I can deliver videos to you guys that meet what you're looking to learn from and get exposure to. And if there's anything that maybe you're more experienced in real estate investing than I am, and you want to say, hey, Steve, you got this wrong, or hey, Steve, clean this up a little bit, that's great for not only me, but everyone else watching the video as well. So again, thanks for everyone who took the time to kind of make it through all the way to the end. If you want to connect with me, SJ Lincoln Realty is going to be all the social handles, so certainly feel free. That is my real estate brokerage. I am a licensed real estate broker here in upstate New York and all of New York State. So you can certainly reach out to me if you have any housing related needs in the state of New York. And then obviously, financing, we can have a conversation about that too. But Stephen at sjlincoln.com, sjlincoln.com/join. If you want to become a subscriber to our newsletter. I know I'm throwing a lot of stuff at you guys to plug at the last minute here, but become a subscriber to our newsletter. That's free. And obviously, if you want to subscribe to the YouTube channel, that's great too. Again, my name is Steve Lutman with SJ Lincoln Realty, and thanks for watching.